It's October of 2020, and we've just gone through quarantines across the country. Vacancy in office space is very high in major central business districts, and we're still in a pandemic. And yet cap rates continue to decline for some product types in many markets across the United States, which might mean that prices are still rising on certain forms of commercial investment real estate. The question is, why is that happening? Hi, I'm Loren Keim with Lehigh University's Goodman Center for Real Estate Studies. Several large institutions and brokerages produce regular surveys of investors to track their expectations as to where cap rates are going to go over the next quarter, over the next year, over the next 5 years. These investor surveys, whether they're done by RealtyRates.com or PwC, or brokerages like CBRE or Cushman & Wakefield, cover a wide spectrum of product types, including multifamily, office, retail, industrial, and even medical and hospitality in some surveys. So what does it mean that cap rates are falling? A cap rate is calculated by dividing the net operating income, the income of the property after operating expenses, by the acquisition price of the property. And cap rates are inversely related to the price an investor is willing to pay for an investment property. For example, if an investor is willing to buy at a low cap rate, that means they're willing to pay more for the property than if they demand a higher cap rate. So let's look at what's happening in the market by reviewing the trends year over year from the second quarter of 2019 until today. One of the hottest product types for several years has been multifamily, and there are many reasons for that. The home ownership rate has fallen during the Great Recession, meaning more households have become renters than any time since the 1970s. Many millennials decided to rent rather than purchase because of the flexibility to job hop around the country, as well as higher unemployment rate of millennials during the recession. And the population of the United States is rising, meaning there's a need for more housing. All of that drove up rental prices and made multifamily a strong investment vehicle. In many suburban markets over the past year, cap rates continued to fall for multifamily properties, indicating that investors valued properties at higher values relative to net operating income of the first year of the investment. In some major urban centers, such as New York, cap rates actually rose, indicating that investors are reducing their expectation of property values relative to their first year's net operating income. Now, this might be because of the flight of tenants from cities, as more office workers decide that they can work remotely, and as more urban tenants decide it's riskier in the future for the next pandemic to be in such confined areas. There is movement out of major cities, out of gateway cities. The multifamily vacancy rate in New York City is creeping up as tenants move to northern New Jersey or Westchester County or Long Island or to the Poconos in Pennsylvania or to Connecticut. In contrast, that flight from central business districts in major U.S. cities to the suburbs should indicate a drop in property values in the office building sector, but we're not seeing that yet. Incidentally, in investor surveys, office space is often separated by central business district space versus suburban office space. Now, despite more people working from home, and despite the flood of residents of major cities moving out to the suburbs, investors see office cap rates continuing to be stable, and in some cases, even drop in some of those gateway markets. Remember that cap rates are inverse to acquisition price, so the higher the cap rate, the less the investor is paying for that asset. The lower the cap rate, the more the investor is paying. In some areas like Atlanta and Denver, we've seen cap rates rise over the past year, indicating falling property values, while other cities such as New York and Miami have seen them decline. New York City estimates, for example, have office properties trading in the 4.25% to 4.5% range. Now keep in mind that investors are willing to trade properties at these low cap rates because they expect the growth rate to drive up their profits. And investor surveys indicate that investors believe the office market is going to bounce back, but only time will tell. Other sectors include the industrial and warehouse market. Now, obviously, with the huge rise in e-commerce, which has been accelerated, by the way, by quarantines across the country. Warehousing and distribution have been quite strong. Many markets across the country are seeing cap rates falling. And finally, for today's update, the retail sector. What we're seeing is that grocery-anchored retail centers continue to be strong. Although 14 of 29 tracked markets in the latest CBRE report saw cap rates increase over the past year in grocery-anchored retail, while only 5 markets saw cap rates decrease. Those anchors tend to be strong, of course, with population rising and the need for food to be a basic necessity. But small strip centers and regional malls are taking a hit. We've watched large REITs, real estate investment trusts, withdraw from purchases of retail centers that were pending prior to the quarantines. There is a higher retail vacancy in many markets due to tenant defaults, and that available space is taking longer to lease. One of the interesting conclusions I'm drawing from most recent investor surveys is that investors seem to believe that most property types will bounce back over the next year. And part of the reason is the record low interest rates. Investors are finding low 3% fixed rate loans for strong assets. Extremely cheap money means an investor can afford a temporarily reduced return and still achieve the required profit. Now, my final note for today is that stable cap rates don't tell the whole story. While cap rates for sales may be holding relatively steady, prices may be falling in some markets because the property value is based on the net operating income, the NOI. If a product type is experiencing a higher vacancy rate or a higher collection loss, that NOI will be reduced, so the NOI divided by the cap rate equals a lower property value, even though you're looking at the same cap rates as last year. I hope you found today's update helpful, and if you did, please subscribe to follow us so that you'll be alerted on our next updates. Thanks.